delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
All right, welcome back to another episode of the Total Money Management Podcast. I've got Jacob and Steve here with me.
G'day.
How we doing, gents?
Good. End of the year. Feeling Christmassy.
Feeling
5,000 degrees.
Yeah. Go outside, have a swim. Shit, it's hot. Right, back into the aircon. Cricket on.
Well, look, the intention of the podcast today, we're going to switch it up a little bit. It's going to be more conversational than some of the previous ones. And really the intent of today, gentlemen, is just to review, what's happened in 2023 and start to look forward into 2024 and where the opportunities might lie.
Excellent.
Just having a look at this, right? I mean, let's just start off with the S&P 500. Almost 23% this year.
Hallelujah, brother.
I mean, looking at the Cape ratio at the start of the year, I will say I wasn't expecting that.
Yeah.
No. But here we are.
Yep.
Steve, do you think that's mostly off the back of the Magnificent Seven?
Yeah. Definitely. If you look at the distribution of returns, normally you got 500 companies in the S&P, and it's a market cap weighted index, which means the big companies, when people put money passively into the market, i.e. I'm just going to buy the S&P 500 and buy SPY, right, which is an ETF. What you're doing, if you put $100 in, what they do is say, if Apple is 11% of the total market cap, we're going to buy $11 worth of Apple.
For every $100 they put in.
That's exactly right. So what happens is you get this tremendous, burst in the bigger companies because that's where the weight of the money is going passively, right? Which is people just buying the index. It's different if you pick stocks. But what's happened is everybody's got into the big seven, so there's just been more and more momentum. But what you said at the start there is interesting because when you look at a CAPE of 30, and it's been as high as 33, but that's where it's important to keep that time frame, that 10-year time frame, because it can be 30 and it can stay 30 for 2 or 3 years, but then it'll go to 10, right?
Yeah.
And you go, okay, that's where the big 40% or 50% fall can come from.
Yeah. Oh, look, that makes perfect sense. I mean, it's probably also driven, right? Like this year, the buzzword's been AI.
Yeah.
So everything to do with AI has gone absolutely bonkers.
Yeah.
I mean, looking at this as well, tech stocks, telecommunication, they're both up 22%. So
yeah, I mean, it feels for me, you look at tech stocks and AI obviously came out this year and went absolutely gangbusters, but tech stocks PEs and kind of valuations have been insanely high for years now.
Yep.
And the question I have for myself is when will they ever come down? What's the average? When will they ever revert to the mean? Will they ever? What would that mean for the greater sector?
Yeah.
It just feels like they're never going to come down, and that's why you get this sentiment of just invest in the Magnificent Seven, just put your money into the index, and it will always ever go up. But you're like, well, it can't continue forever. But when?
Yeah. But that's the thing about investing is always, and I've noticed this over the last 6 months, is exactly that question, right? Which is, they're really expensive, but when are they going to fall? And it's like, mate, if I knew that, I'd be short 100% the day before.
Yeah.
So, that's the value. That's the value of valuation, because the bubble stocks and asset classes go on for longer than you think.
But how do you value something like Facebook that can just fabricate a product out of its ass that costs nothing, like the metaverse or
the metaverse cost him
exactly
$5 billion. But I get your point, though.
Shot it through the roof.
I mean, you can burn that much money and then go, I'm still on a PE of 50.
Yeah.
But I think, the tech sector is is the ultimate sort of growth sector because, like you say, you can invent a product really cheaply and sell it, and the profit margins are huge, which flows through to the share price, right?
And
so,
insanely scalable too, right?
absolutely. I would say just on that, like I got charged $109 to renew my Microsoft Word or
Office
whatever it is, right?
license.
Yeah. Last year it was $99, and you sort of go, oh yeah, $10, but you look at it and say, well, hang on, that's 10% of 99. So why am I paying an extra 10%? Now times that by
The billions of people
billion
using it.
people using Word. No wonder fucking Bill Gates has got a lot of money, right? But it's what you say, Tom. The thing about IT, which is different from building cars, is you get that scalability that's, and what they call the network effect, right? And that's what they're all trying for. They're all trying to get that network effect. And that's really different from saying we're going to build a motor car, because you can't, you can scale it up, but it takes a really long time. There's lots of complexity. Whereas if you roll out, I don't know that much about AI, but you look at a few of them.
Terrifying.
Well, it is in my mind, but the competitiveness is what interests me in that sense. You see, because when I look at it and go, well, there's going to be different sort of things of AI. So how does that impact the share price of these companies? And that's where I think, like you say, Jacob, you say, oh, this is just going to go on forever, because after AI there'll be, they'll have some new product, but
And they'll keep improving it.
yeah, but this is what Schiller talks about, where he says you get this, new era bubble, and what happens is we go to everything's going to be different, and it's like, well, it might be, but I can't remember, it might have been last week or a fortnight ago, I was saying to someone, the question is, what's the price, right? So what? We all know about AI. If you're an investor, you want to know how much you're going to pay for it and how much is it going to be worth. And at the moment, when you look at the IT companies or the big seven, what you're doing is pricing it for perfection, right? So, that's what you got to consider.
Yeah, absolutely.
I mean, I find it hard to value something like Google, where what I feel like is most people try to value Google like they might try to value Bunnings, where you can say, okay, Bunnings has 9 million bathtubs. That's because they've got all these workers that make the bathtubs, and the bathtub's worth X, and they sell it at Y.
Yeah.
Which you can't do that. You can't value a tech company under that construct or framework, because what is a piece of data worth?
Yeah.
But they make it's the ads, right? They're all in the same game. Like Facebook, we get to consume Facebook for nothing, but people advertising on Facebook are paying an absolute fortune.
Yeah, we
for
advertise
ads.
on Facebook.
Yeah.
But I think, I don't know whether I think you can. The thing that the reason why Google's a good investment is because they've got 95% of search,
Yeah.
right? That's, even if they said, well, it's $1 a search, you'd go, man, that's going to be a lot of money. I think the concern for me is not with Google. Well, with Google currently, with the court case, which looks like it might have struck a little bit of trouble, but generally for those companies, it's quite hard to price them, because what you're talking about is pricing in, you're buying the future. And so the question comes back to, well, how much revenue are they going to make in the future? And what I've found is generally you are overly optimistic about how the future's going to go. And so you tend to think, the stock's at 100. Oh, well, it's going to be worth 200 in 3 years, because what you're doing is just extrapolating with a recency bias. Like, it's gone up 3 times this year. Well, it's going to keep going, right? And that's the hard part.
You never know. Someone else could knock them off. I mean, a classic example is let's use Google. With OpenAI now, Bing have been nowhere for couldn't tell you the last time I used Bing. Now they've partnered with ChatGPT and OpenAI, and that's their main search engine
Yeah,
for
yeah.
ChatGPT. So if everyone starts to use ChatGPT and says, "Hey, tell me blah blah blah," it won't use Google, it will use Bing. People start to use ChatGPT. Like, what will that start to eat into their market? Who knows? But there will be a point where I think someone knocks the head off Google or Facebook or whoever else, and
Yeah,
we might see a downturn.
you can sort of say there's AI is the future, and that's not a controversial statement, but the question is, the next level down is, but who's going to win the race, right? Like, like airlines will change the future, and they did. Yeah, okay, but which airline company should I be investing in, right? And that's the hard part.
To be frank, it is pretty amazing what you can do with it. I remember Jacob and I, about a year ago, we had a bunch of strategies that we were looking to backtest. And at that time, we used to have to go find people who could build the script in TradingView.
Yep.
So then we could run all the backtests.
Right.
Or
When
manually do it through an Excel sheet, which is awful.
Which is fine, but time consuming. All right, with ChatGPT, we could sit there and go, all right, these are my conditions, every time we're over this moving average, put a sell order in of X percentage of my portfolio, and then run that test for the last 5 years. And within 20 minutes, you can get ChatGPT to build that for you.
Yeah, all the data.
And you can run it. So, I mean, look.
But it raises a lot of questions about, and I think I wrote about this a few weeks ago in the week that was, that when you listen to what the capability is, it's pretty, like you said, Jacob, it's pretty terrifying. Like you sort of look at it and go, I look and go engineering,
Marketing,
music, art, medical, legal, accounting. Like you start to walk through jobs and go, geez, there's going to be a lot of unemployed people.
How many decisions can this thing make?
As it gets sharper, it is deadly how good some of the stuff that comes out is.
Well, hence I think in Europe, I think yesterday they came up with regulations about it, because I think it is when as I say, when you do look at it, you go, man, this thing's just going to wipe out heaps and heaps of jobs. But my argument is that will actually be a good thing, because we're going to need
more labourers to build houses.
Absolutely, but for demographics, right? Yeah. There's going to be, if we're going to have an infrastructure program, we're going to need a lot more people who actually do lump cement and, put nails in wood. So it may actually be a successful transition from to take us to the green economy, right? Where we're still going to need we're going to need to rebuild infrastructure, blah 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 blah.
Interesting. Yeah. Last night on ChatGPT, the CEO or founder, whatever his name is, can't remember his name. He walks around every day with a backpack on. I think I've told you before, Tom. He walks around with he's got a blue backpack that he walks around every day with.
Yep.
And the only thing in that backpack are the kill codes for ChatGPT in case it goes rogue. I think that the fact that you have to do that is nuts.
Yeah.
But anyway, that's ChatGPT. Back to US stocks. I mean, review that it's been a cracker year.
Yep.
It's been a great year. People have made amazing returns. What do you reckon for 24?
Thanks.
Steve Moriarty.
No pressure. Look, to be quite honest, I think 2024 is an election year. I would find it that the US economy is doing really well, right? The government's pumped a boatload of money in there. Because we've got a lot of debt, because there's a lot of debt, the US interest bill payment is now somewhere around $900 million to $1 trillion a year, right? So
just an interest.
Sorry,
Just an interest.
But see, that's people go, oh my God,
Australia's economy?
Well, yeah, Australia's economy is about 1.7 trillion. So, but see, that feeds in to that money goes to people who will spend it, right? Now, it's a little bit more complicated depending who gets the money, because if the wealthy end get it, they're not going to spend it. But if you give it to the poor people will spend it, and that will create more economic growth, right? Yeah. So the US is booming really well. There's talk of a recession, and I'm not sure that's actually right. I think, again, and like we've talked about in prior episodes, I think people are working under an old paradigm. Look, there might be a recession, but if the US economy is getting $1 trillion in interest, huge government spending with Biden's Inflation Reduction Act and the CHIPS Act, and it's an election year, you'd hardly think they're going to let the economy fall into a recession.
Yeah.
There's also, I think, the one of the main points is the Federal Reserve realises that there's an absolutely huge, overwhelming amount of debt out there, not just in the US, but in the world. And so it's going to continue to provide liquidity into the market. So again, tying back to what we've talked about previously, the returns might be low, but there won't be a big crash. But they're what I'm saying is...
But there might be a big crash.
Well, yeah, I can't tell you, when there's going to be a big crash.
Yeah.
But what I can say is, listen, the Cape's at 30. Generally, that means it's going to fall down. Now, Is it fall down next year? I don't know. Yeah. But does it fall down over the next 10? More than likely. Yeah. But what I think is, as I said to you before, if I'm working in a new paradigm where we're looking at an equivalent point in history, I think what you find is it might actually go down 10% and then 7%, then go up 15 and then go down 20. So there'll be a lot of volatility, but
it'll be a stepping stone.
Well, yeah,
not like the COVID.
Well, the valuations are high, right? And we know with 150 years worth of data, it's going to mean revert. Right now, I can't tell you when, I can't tell you why, but that's what the data shows.
Yeah. And what does that mean? I mean, Tom, what do you reckon it means for asset allocation? Like, what are we going to be looking at next year in 24?
Yeah, well, look, for the last couple of years, my strategy, probably at least 60% of my portfolio has been cash.
Yeah.
Just because so much is heavily overvalued. Personally, I've started to put a bit of money into energy, and we'll probably touch on sectors shortly anyway, talk about overall valuations. But, I mean, they've had a couple of pretty ordinary years. We got off to a bit of a false start this year. And obviously last quarter we saw that correct again. On the other note, most of the cash I have in the market at the moment is more short-term stuff. So,
In term deposits kind of stuff?
No, well, my cash is obviously sitting in a bank account, which 5.2% or whatever.
It's pretty good, isn't it? When it's
not bad.
Well, it's not bad, right? When it can't really go down.
Well, it's a lot bloody better than one.
But yeah, well, the other thing is our well one strategy. That's where most of the money is.
Right.
Yeah. So that's more of an active.
Crack a month last month.
Yeah. Well, obviously that's a more active strategy, right? Where daily we're either pulling some money out or making a buy, but it doesn't take a lot of time. And the thing I like about that is there's strict rules in place. So if it gets below our point, we pull the pin. Then I've got cash there if we do have a big crash. And if it was a false drop, then we'll be in again.
I think that's why I think that type of strategy is going to be more important than a buy and hold strategy. I mean, you guys know we don't like buy and hold anyway in terms of long term. But what I'm saying is because of the volatility, this year's a perfect year, right? You're up 20%. You're thinking, man, this is great. I'm going to ride this sucker. Whereas the best idea is to go, okay, this has been a pretty good year. We've seen that it's really tilted towards IT and tech stocks. The Magnificent Seven, okay, I'm going to rebalance and I'm going to take, some of the profit off the table. If the Cape was at 12, I'd be going, dude, write it out. You'll be fine.
Yeah.
But at 30, it's a different proposition. And that's where I think we differ from a lot of the mainstream because they're like, yeah, it'll be fine. Just keep going. And it's like, okay.
Ride the waves, dude.
Absolutely.
Well, yeah, I just like it because you're not sitting there going, what happens if it drops? It doesn't matter if it drops.
Yes.
And if it keeps going up, it doesn't matter if I can explain or understand why it's still going up.
Yep.
It's fine.
So I think what I'm hearing out of that is we've got the strategy for the next few years will be more important than what it is that you buy. There's obviously going to be cheap sectors and expensive sectors, cheap stocks, expensive stocks. But the main thing I'm hearing is that if you have a strategy going into 24 and beyond, let's just say 2024 to 2030, you'll fare off a lot better than most people.
Absolutely. You're going to have to be a little, I'd say this all the time anyway. You're going to have to be a little bit more active than simply buying something and saying, well, let's talk about Bitcoin, right? Because you guys were talking about, Tom, you had a survey or something about...
I was talking about Michael Saylor, who's obviously been, a big fan of Bitcoin the last few years, runs MicroStrategy. I don't remember the exact count, but billions and billions of dollars worth of Bitcoin.
Yep.
He released a poll on Twitter the other day, and he said, how high would Bitcoin have to go for you to consider selling and taking some profit?
Yep.
30.9% of people said 100 grand is their number, so
And
100K
the current
US.
price is about 40?
It's about 43K US.
43, right.
Yep.
So a double.
Bit over
double.
double.
And bit, yeah.
Yep. 18.9% of people said over 250,000 US. 14% of people said
Good thing.
over 500,000 US before they would even consider taking any profit. And then 36.3% of people said it would need to go over $1 million. But that same group also said they may never sell.
Right.
So, I mean, when you
never
look at
sell.
that does make you nervous, right?
Yeah.
Yeah.
You're sitting there going,
Yeah. Well, Meb Faber did a survey, I think this year or maybe last year, where he said, "What would you be comfortable owning US stocks, I think, at a PE of 50 or something, like the overall market, and something like that? And like, would you sell at 50 or a PE or 100? And most people are like, no.
Just hold.
Well, but look, it might. I think if you say no, then my argument is you don't know what you're doing.
Yeah. You're speculating.
like, let's be
Well,
honest.
yeah.
We've spoken about this before, right? It's all well and good to say, when it hits this number, I'm going to sell. But if you've bought a stock, it's gone up a lot, it's actually really hard to sell.
Absolutely.
Like it actually is. Unless, and I feel like everyone goes, you have to have a strategy. What does that mean though? But if you do have a system where it is robotic, then, you go, well, they're just my rules. I sell some. And it makes it a lot easier. Like for me, before I had that, I found it next to impossible.
Well, because you haven't got a strategy.
Yeah. And I envied Jacob because his gut feeling would be like, yep, up 300%, boom. Locked it in. And I'm sitting there going, yeah, you wait till I'm up 600%,
Yeah, but
You'll
the only
come
reason I did that was because I lost a lot at the beginning when I didn't have a strategy.
You're the wise man, mate.
I'm the
But that's
wise
what.
old man.
But I mean, that's the classic case, isn't it? That the thing that we don't do, and this is what we harp on about a lot, is the time, right? And what I mean by that is that Daniel Kahneman, his book, right, Thinking Fast, Thinking Slow, said there is no stronger emotion than the one you feel at that point in time, right? And that's what makes it really hard, because with investing, what you're doing is saying, I'm up 300% and it's going to go further. Now, you have no idea whether it's going to go further. And then more than likely, it's going to go into reverse, right? But what you're doing is not saying, oh, well, that's all right. I'm going to sell and I'm going to find something else to buy, which is projecting into time, right? And this is, again, this really important concept in investing about how you look at it, because people don't put themselves in that position where they say, well, yeah, I can sell this and then I'll find something else to buy, right? Because it's, again, why, you imagine being Warren Buffett, right? He's got all of this cash at these high points in the market, but he's just saying, Buffett knows, well, there'll be more opportunities and I'll get a chance to buy, right? But hardly any investor thinks like that, right? Which is what you're sort of saying, Tom. You start projecting out, oh, no. Whereas Jacob did the right thing, which is saying, hey, listen, I just landed 300%. I'm going to take it off the table. If it goes to 600, fine. But Jacob's going to get another chance to buy more stock.
Yeah, I think you just made the point just for Steve. It's a knowledge gap as well, where people get in early days, or they've got a really surface level knowledge of investing. They have a win and go, shit, if I take my money out now, I need to actually learn how to find the next stock.
Yeah.
So, what I'll do is I'll just keep it in the market and ride the waves, because that's what we've always done.
But they're encouraged to do that too.
Yeah, for sure. But use something like Bitcoin. We'll go back. If you invested it's 10 years old now, ish. Well, really 10 years old since it's been on the main exchanges. If you invested $4,000 10 years ago, it's had a year-on-year average return of 74%. You'd be a millionaire.
Yep.
And what people fail to realize is that Bitcoin has only ever existed in a macro bull market when the US has gone absolutely gangbusters
when
over
there's
the last
cheap
10
money.
years. When there's cheap money,
Yep.
So where these people that may have invested $5,000 or $10,000 10 years ago, who are now multi-millionaires, are thinking, well, I'll never sell. Why would I sell?
Yeah, because it's going to go to $1 million.
I'll be a billionaire in the next 10 years.
Well, my argument would be, the question to ask is, when would you sell if it fell? Like, would you sell if it fell 20% or 40% or 50%? Because that's when the real questions, that's when you look. It's the old Mike Tyson. Well, it's the old Mike Tyson, right? Everyone's got a plan until they get punched in the face, right? And when you go, I wouldn't sell for $1 million, it's like, yeah, sure, buddy, that's fine. What about if it's at $10?
Yeah.
Right? Yeah. Then you go, no, then I'd buy more. It's like, oh, yeah, okay, best of luck on that, right? Because we know that's not what people do, because they get stuck in the moment going, oh, yeah, I can't see Bitcoin under anything under 100. It's like, mate, every stock market bubble has been, oh, yeah, these stocks are going to the moon. It's a new era, blah, blah, blah. Boom, crash. Nobody saw that coming. And what I'm saying is, I don't need to know what it is. All I need to know is, what are the consequences? It could be a world war. Yeah, it could be a world war. It could be, an explosion in oil. Yeah, it could be an explosion. It could be one of 100 events. That's not the point. The point is, how am I exposed? And, what's my plan to get out?
100%. I mean, that's the thing, right? Not to make this a crypto podcast or anything like that. But the reason, we've all got these stories. Like, I still remember in 2011, a colleague telling me to buy some. And I think everyone's probably had that experience at some point.
Of course.
And it wasn't until it was over, Bitcoin hit, I think, 1,700 US for the first time that I bought some.
Right.
Like, so dumb. Obviously, just giving in to FOMO, all the things that, most people do when they start investing, which is really just gambling. But the thing that I've always come back to, and I even said it then, is I had a trouble wrapping my head around it because I couldn't value it. Like, I couldn't go, what's it actually worth? Like, I
still can't.
Nothing.
No, but I understand that, like, there's getting less and less all the time and blah, blah. But the nice thing about where we are today, and obviously because we got to work with you, is we actually don't care what it's worth. Yeah. Like, there's volatility and we can trade it, and we're not invested emotionally.
I was going to say the exact same thing.
It's like, it's nice actually being able to sit here going, if it goes to $1 million, awesome. But if it doesn't, that's fine too.
Yeah.
Well, that's the same for any other stock or sector or ETF. I mean, I get asked at least every couple of days, like, what would you do if this X, Y, and Z stock goes to $1 million, or Bitcoin goes to 100,000, or if it goes to $10? And my response every time is, I don't care. I don't care. The strategy I don't need to know what the price is for the strategy to work.
Yeah. That's ultimately what you want, which is the rebalancing stuff. If it goes up, great. If it goes up, I'll just keep peeling money off. And what you find is, using things like CAPE, that the higher CAPE goes, the more you should take off. But once you're comfortable with that strategy, or once you're comfortable knowing that, that's why, to me, it's so important if you're a long-term investor, because what you know the market's going to blow up, right? And the fatal flaw of mainstream finance is, if you can't tell me what the event is, then, you have to stay silent. And it's like, no. All I'm looking at is the exposure and going, mate, I don't know what the event will be. And yes, absolutely, the CAPE at 30 could go on to, 40 and 50. But the higher it rises, the higher the risk goes.
Yeah.
And we've had a fairly standard sort of bull market from 2009, where the US, I think, is up about 500% or something, over that 14 years. But that's a standard bull market, right? Again, if you go and look at stock market history, that's a pretty average sort of bull market. But the other thing you want to realise too is you go and look at it and go, yeah, that's funny. Every one of them lost 50 or, like it doesn't go on forever. And you need to be positioned for that rather than just going, well, you can't tell me what it is, so stuff that. I'm staying 95 invested. It's like, okay, well, fair enough.
Yeah, fair enough. I won't be.
Absolutely.
I want to start going hard when it's under 15.
But there will be opportunities for 2024.
100%. Yeah. So you asked me a question about 10 minutes ago, and we went in a big tangent. For me personally, I'm going to go with the active, more of a trading style next year for majority of my portfolio. Yeah. I'll keep a lot of cash on the sideline, and I'll probably I haven't determined the exact allocations yet, but probably around 10% into a couple of cheap sectors. Energy's one that I like.
Yeah. Energy, I think, is a good long-term one. The PE, if you look at the PE on energy, it's just crazy. It's just like crazy. 10. I look at...
it's 10, right?
10.2, yeah. You got comm services at 36, which is insane.
I mean, that's seriously low.
That doesn't make sense to me, though. Haven't all things energy been going...
It was lower. When Steve told us to buy the oil ETF.
But that was 2 years ago.
That went nuts.
That was 2 years ago.
Yeah.
And it's still cheap.
Well, it went up a lot. I had a look at, disclosure. I hold Woodside. And if you look at Woodside went up about 20%. Well, my Woodside did anyway. But now it's back down to where I bought it. And in fact, I think I'm actually now... about 4% lower than where I bought it. I think I bought it around 30, right? Now,
dividend's pretty good though in Woodside, isn't it?
Yeah, throw in the dividend. But the PE on Woodside is like, I don't know, 6 or something. Now they're talking about getting into a merger with Santos, but that's more specific. But generally, energy and utilities look cheap. Now, here's the important part of that. The important part of that is they do well in inflationary environments. Right? And if we're walking into higher for longer, which I think we are, which we've argued, then I think energy is going to be a good asset to own. So, that's where I've got a fair bit of my portfolio.
Yeah, but it's definitely not advice.
Sorry?
But it's definitely not advice.
No.
What about financials at, what is it, 14.9?
Yeah. I'm a bit, I don't know. I do this every time, but I think financials will be one of the picks for the Well 2 strategy. It'll be in the bottom 3 with energy.
Yeah.
And I think the other one's consumer discretionary. But don't hold me on that. But the thing about financials is my concern is the level of debt that we have. And so... For example, let's use Australia. You've got the big 4, right? If you look at them, their exposure to the mortgage market is enormous. And that's what concerns me. Because it's hard for, banks make money by lending money, right? Well, the banks have been spectacular. Well, Commonwealth Bank has been anyway, for about the last 20 years, right? I remember looking at Commonwealth Bank. I bought some first in 2000 for $28. But I went back and looked at it. I think it's 1991 or something around there. If you'd have bought it then, up until about 5 years ago, because I haven't done the last 5 years, but it was like 15% compound or something. Like it was an seriously fantastic return. But that's because we've had a mortgage explosion from 2000 onwards.
Yeah.
Do you know what I mean?
Yeah. I mean, one thing that, again, gets me thinking about financials it might be all right, it might not be, is that there's a lot of data to suggest that people are still managing to pay their mortgages. Like they're paying the bills.
Yeah. But they're running
the things that matter.
Well, yeah, but you've got to be careful there because the argument was, we're going to have a mortgage cliff. Then 6 months later, you get all these blokes in property going, bullshit, there's no mortgage cliff. And it's like, mate, it's been 6 months. Yeah. People have got a lot of money in the offset account. Right, they're running those down. They're running down their savings accounts.
Yeah.
Right. So and we've had an influx of Chinese money and buying particularly in Sydney.
Yeah.
But and this feeds into what we're going to talk. We should talk about the economy because, the Australian GDP is 2%. Borrowing is running higher than the GDP level, and that can't be sustained forever. And so my argument is, again, people are saying, oh, well, that thing about the mortgage cliff, that's wrong. And my argument is it hasn't even started yet. It hasn't even begun to bite. And again, Jacob, you get this, and I'm not just picking on property. This is the same with stocks, right? It's the same. Mate, you're wrong. It's going to go on forever. People are still paying the bills. And I saw something stupid this morning where someone said, oh, it wouldn't matter if unemployment went to 4, it won't change property prices. It's like, really? I mean, that's just bullshit. People lose their job. They can't pay a goddamn mortgage. So they really need to get another job as well as the one they've got. But if we've got growth that is, we're in a per capita recession, well, best of luck with that stuff. So again, it gets to that issue of time, right? Because we're all living in the present going, well, it hasn't happened. And it's like, okay, that's what the turkey thought after 990 days before Thanksgiving, right? Hey, these people are really nice, And then it's like, off with their head.
Yeah.
But seriously, that's what goes on, right? You're thinking, hey, this is all really good.
It's good to get context because, you're looking at all these newspaper articles and the news and you're like, oh, yeah, consumer discretionaries and everything's going down because people they're paying the mortgage and they're paying the things that make, that they actually need to. But that's a good point you bring up. Like when will it happen that they've ran their offset, they've ran their savings, and now they're like, oh shit, we can't pay the mortgage anymore.
It's all noise.
But there's also if you look in a little deeper, what you'll see is there's quite a few properties around Australia that are selling below the list price.
Oh, okay. Yeah, I
right.
haven't looked at that.
And again, it's from my point of view, which we're talking about in our second book, it's don't ask the barber if you need a haircut. Right? Of course he's going to tell you need a haircut. Well, you show me how many people in the stock industry or in the property markets are saying, listen, mate, things are really expensive. I'd be, very cautious here, right? Or if you're going to buy a property, you really want to buy something that is seriously cheap, and you can do that by saying, okay, well, what would the rental yield be?
Yeah.
Right? And as Tom said before, well, I can get 5.25 risk-free in an account and have, walk into the bank and go, give me my 50 grand. They go, sure, here it is. But if you've got a property that's earning 2, if you're lucky, and you say, oh, well, I want to get out, well, then you've got to spend 20 grand. You've got to advertise it. You've got to get rid of it. You've got to pay the cost. So there's a liquidity issue. So it's not as simple as, that idea that people say. And sorry, just while I'm on that, the other thing too is just because you can pay an investment doesn't mean it's a good investment, right? And this is my argument about property. If you get to the point where you go, we're losing money on negative gearing, but that's okay because we're going to make 200 grand when we sell it. Okay, that's good. Now when you go, oh, actually, we're not going to make 200 grand when we sell it, and in fact, the property prices have fallen quickly, that's when you say, to me, the argument of, oh, don't worry about it, Jacob, you'll be right, mate, just keep paying it off. Mm-hmm. And it's like, but hang on, Steve, it could stay low for 10 years. Like, oh, well, mate, that's all right.
Just keep paying the bill.
Just keep paying the bill.
The point?
And I know people who have bought property and have made lots of money. I also know people who've bought property and gone, man, that was a really shitty investment, right? Because they bought at the peak, or they didn't do the proper numbers. And a lot of it is involved around this idea of negative gearing, right? And that's why I say, borrow $1 million.
For investment properties, though, like if it's your personal, your primary residence, a lot of people aren't going to be too focused on that. The capital gains will probably be a nice...
On the PPR?
Yeah.
Well, yeah, of course. But then what do you do?
It's your home.
Yeah, I know, but see, this is where I think stocks are better. If I make 100 grand in stocks, I can sell it and then I can just let it sit there. If I sell my PPR, I'm homeless. Now, I'm not being, I'm being trite, but what I'm saying is, it's not like
You can't live in a share.
Well, no, I know, but see, that's my point. You can make 100 grand in stocks, and then say, righto, I'm going to leave it in my bank account, and I'm still living in a home. If you say we're going to sell the PPR for principal place of residence for 1.2 million, right? Oh, we made 300,000. Okay, but you still got to now go and buy somewhere. Now, if you sell in a high market, how many people are going to say, well, that's okay, I'll just rent until I find a suitable property? Okay, fair enough. At the moment, the rental vacancy rate's about point zot, so, best of luck finding a place to move into. So, again, the idea was in property, so long as you buy and sell in the same market, it's right. It's good. And it's like, no. You want to sell it when it's really stupid high, and you want to buy the next property when it's really low. There's a space in between where that happens, and you need to wait. Now, I can do that with shares. Can I say, like you said, Dom, oh, well, that's cool. I'm getting 5.25 and, I'm happy doing that. And I'll wait for I'll wait for a really good share to come along. Now, you can do that in property, but once you move out, you got to be moving into something. So I think that's a little bit tricky, because I haven't found too many people who said, we bought for $1 million, we sold for 1.5, and then we went and bought for $1 million again and shrunk our mortgage, right? Because most people, again, like stocks, go, now I'm going to go and buy more stocks because, it's all booming. So
I'll go get a $1.7 million house.
Exactly right.
For me,
that's what they've been doing.
For me, it's how easy it's been to over-leverage yourself and have 4 different negatively geared proproperties.
Yep.
Like, that's, I think, the danger, or what really does
Absolutely.
just scares me. Like, the banks will go, yep, here you go, here's 800,000, and it's negatively geared for 10 years, and capital gains aren't guaranteed. That's what I think makes me afraid.
Yeah. Well, it's
Obviously, borrowing capacity is dropping as the rates rise too.
Yeah.
So, at what point do you think it goes, well, someone making $200,000 a year can only get it, as rates climb, might only be approved for a $700,000 loan if they don't have a guarantor.
Yeah.
Like, at what point does it go, hang on a second, I have to be in the top 1% of the top 1%?
Yeah, well, that was
to actually get a home.
Someone wrote that, I think in Sydney you have to earn 300,000 or something to get a decent
loan.
A decent loan for
like a family income.
For an average property. And to me, that's like seriously nuts, because Sydney is something like 10 or 11 times income, and it gets back to the point you said right at the start, Tom. Right, which is, I don't know what happens, but Jesus Christ, the long term average has been 4, right? So if it's 11, then you have to say to yourself, please explain to me why it's 11, right? Why is it different? And people will give you all sorts of reasons, right? Oh, it's immigration, blah, blah, blah. Australian property prices have been booming since 2000, right? And there's a whole raft of reasons for it, which we'll talk about next year. But the point being, like stocks, and like you said, Jacob, when does it roll over? And it's like, I don't know when it rolls over, but Jesus Christ, I am not paying 11 times income for a property, right? That's like asking me to pay basically 50 PE for a stock and be confident that it's going to, that I've got to pay it off and it'll roll on. It's like, best of luck with that.
Yeah. I feel sorry for the people that don't have a property. I mean, the people there's a stat that came out where there's more people that have multiple homes than there are with. I can't really articulate it the way I want to, but there are with people with no homes wanting to get into
renters.
the market.
Right? Yeah.
There's more. So Bob and Mary might have 6 houses, and they're just using the capital gains because it's been booming for 20 years to get another loan.
Yeah. Equity in the previous property.
In the previous property. Blah blah blah.
But that's where people get into trouble.
Exactly what I'm trying to say.
Yep.
It's the rollover point will affect Bob and Mary more than the people that are struggling to get into their first home, because to your point, Tom, they can't get a loan right now, so they're having to rent or they're having to house share or something like that. Whereas the the Bob and Mary who have 4 negatively geared properties, or let's just say 2 negatively geared properties and 2 that are in the green, they're going to really feel that effect when the hammer comes down. Yeah. Does that make sense?
It's what you were saying about capital gains versus dividends. Is that right?
Yeah. Well, I'm just saying people are speculating on capital gains, and that they struggle to understand that it's not only about capital gains is only 50% of the game.
Exactly. Yeah, there's the rental yield.
Yeah.
And if that's why I think negative gearing is nuts, right? It's saying to people, you are going to lose money on purpose, but it's all right because the capital gain will go up. Yeah. And my argument is, okay, sometimes it goes up, but you see, because property has risen for 20 years globally, not just in Australia, right? Because it's been the big asset class where all the money's gone, that's where we're lured into a false sense of property always goes up. And it's like, I can tell you, there's plenty of investors who have lost money in property, and there'll be plenty more, right? And it's the same with Bitcoin. It's the same with stocks. It's the same. Look at bonds, right? You know, in COVID, they were buying bonds that were yielding 0.5%. So now bonds are yielding 5.25. Those people who bought a bond at 0.5% have lost something like 70%, right? Oh, yeah, but bonds are they're a risk-free investment. It's like bullshit.
Yeah.
Do you know what I mean? And that's why valuation is really important. But it's hard to do that when everybody's buying property and making money. Everybody's buying AI stocks and they're all killing it. Oh, man, I'm missing out, right?
What about you guys? What are you thinking for next year?
I'm just going to stick to the strategies, the wells 1, 2, and 3. Make sure we rebalance effectively at the end of the year, and beginning of the new year. And just to your point, short-term investments. I do have a fair bit in Bitcoin and crypto. But again, that sticks to the strategy of if it falls to pieces, I'm not going to be exposed. So it's all about just assessing the risk, making sure for me that I've got my eyes wide open with what's happening in the economy. And
smart bastard, isn't he?
Yeah.
Hey, you'll go far. No, I agree. That's
buy the cheap stuff.
Yeah. Well, it's true, you know. Who was it? Charlie? Oh, not Charlie Munger. Who was the other guy that actually lived longer than Charlie Munger? I can't remember. Walter Sloss in the US. He said, buy cheap stocks and something will happen. And, you sort of think, oh, that's pretty simple. But, it's, he outperformed the market, for 30 or 40 years or something.
It's worth highlighting that cheap stocks don't mean that they cost 1 cent. It's about the valuation.
Exactly. Yeah. Thank you, Tom.
Cheap stock could be $100
excellent
a share.
Everyone's going buy penny mining stocks.
It might be 1 cent and still expensive.
Yeah. But that's a good point, Tom. Yeah, it's the price is always in relation to the value, right? The price doesn't tell you anything. The price tells you nothing. It's the value you want, right? Yeah. And when we walk around every day with cars or strawberries or whatever, you've got a general idea of what the value is. What the price is, right? And what the value is. But it's different with stocks and property because the prices can move a lot, right? And that's why at some things, you wouldn't buy, whatever stock at $50, but it's a screaming bargain at 25. Right, and that's the difference, and that's why I say I'm not arguing. I'm arguing property's overvalued because it's had a 20-year bull run. I'm not saying every single property's overvalued.
Yeah.
All I'm saying is, like stocks, when everything's getting chirpy, it's pretty hard to find something that's value without being influenced by, well, it's cheap. And this is a little bit what's happening in stocks at the moment when people say they're relatively cheap. It's like relative to what? Oh, relative to the US. Hang on, but the US is at 30.
Yeah.
Oh, yeah, but this CAPE ratio is only at 22. And it's like, okay, but that's not absolutely cheap. It's relatively cheap. But if the US goes down, as we know, if they go down, everybody else usually tanks as well.
Cheap stocks can always get cheaper. And to your point on the property piece, the property market's overvalued. You can find some cheap property. However, if the property market rolls, those cheap properties will be even cheaper.
Yeah. Well, they could roll further.
Exactly.
Right. Exactly. That's why I think that's important, like you say, Jacob, about sticking to the strategy, because if you can get that in your head and use that Wells, the plug for the Wells coming up, Wells 1, 2, and 3.
Check out the website.
What you really get to understand is that it doesn't matter how the market moves. What you're doing is adjusting your allocation, right, to the market. That's what investors should do. And I find that a lot of the time you can be, people will say, you guys are 30, right? Oh, you guys need a long-term plan.
Hold on a minute, not yet.
Oh, well, 29? 29? 29, all right.
Put me in that bucket, mate.
Huge
Jesus.
difference, mate. But my point being, people say, oh, you've got to have a long-term plan and blah, blah, blah. No, you don't. You just need to know what the value of the market is, right? And if it's really cheap, I'm 61 in 2 months or something. Jesus. But my point being, if the market's cheap, oh no, Steve, you should stay in bonds at 5%. It's like, dude, I can get 12% earnings yield.
Yeah.
It's irrelevant that I'm 61. It's just, what I'm saying is it's not about me. It's the market saying, Steve, I'll give you 11%. Oh, I'm sorry, I'm 61. I'd rather take 4.
Yeah.
And the bonds lost money anyway. Right? So that's why I'm saying, you can make all the plans you like, but the fact is the market dictates the return, right? Unless you say, I'm going to be a stock picker, right? Well, best of luck with how that turns out if you can do that 300 times in the course of your life.
Yeah.
Leading on to, what are you looking at for next year, Steve? I know, we've chatted offline a fair bit about commodities.
Yep.
I know you're pretty bullish on them over the next sort of decade.
Yeah.
Specifically, is that regards to precious metals and generally being recession-proof, or where's your head at with that?
I think I do the Wells 1, 2, and 3. I'm leaning more. Well, Wells 3 is automatic, right? Every 12 months, rebalance, set of ETFs, blah, 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 right? So that's done and dusted. Well 2 is a little bit different, where it depends on what's at the bottom and, you go from there. I like Well 1, but that's because I like looking at the market every day and, it's just my buzz.
Having a tinker.
Volatility makes it exciting.
Yeah, I know it works, so I'm not, I'm not saying it works every day, but I know mathematically it works, right? So, as Jacob said before, it's a bit like, righto, market goes up, I'll take some off, and the market falls, I'll put some in, right? And we've got parameters there. But I think, back to your point, Tom, I think commodities, as we've talked about with the new normal, we're in a different world. We're transitioning to a different world. Commodities, I think, have had a really lackluster 10 years. Go and look at history. They have a bad 10 years, then they have a good 10 years, right? Gold was great in the 70s. Stocks were terrible. Stocks were great in the 80s. Gold was terrible. Stocks were great in the 90s. Gold was terrible. Gold was great in the 2000s. Stocks, were terrible, right? So gold, I think, is a good investment for the next 10 years. Now, I'm not a gold bug. I'm purely looking at it from a historical point of view and looking at the conditions of inflation and saying gold will be a good hedge and a good performer. Commodities, mainly energy, I think. And with that, I'm using a barbell strategy, which is simply what Nasib Taleb talks about, which is 90% in, he says bonds, and then 10% in all these little speculators, right? So my argument is, okay, I've got a fair bit in oil, and then I've got I've probably got 10, maybe 12 speculators, which are in things like graphite, rare earths, and that sort of stuff, which I'm going to delve into for the subscribers more next year. But I think because in my mind, rare earths are now this century's oil. So oil if you go back to 1900, when we really started really getting serious with oil, everything went gangbusters, right? We could build heaps of stuff because we had energy. This century, my argument is we got oil, but the thing everybody's talking about and all governments are talking about is securing supply of critical minerals, right? And I don't think there's a lot of investors that are paying enough attention to that. And just while we're at it, I'm going to talk to people about a strategy of how do you go about buying these things, right? There's Ben Graham's strategy and blah, blah, blah. But my point being, a lot of them are little companies, and that's always a little bit more risky. Yeah. But small caps have underperformed, right? So small caps are looking good. Equal weight will probably be better than market capitalisation. So, we can run through all those in future podcasts, but that's where I'm sort of fairly boring because I've got wells 1, 2 and 3, and 1 and 3 are basically sort of automated, so to speak. Well 2 is the one that fluctuates a bit more, and then I don't look at companies as much as I used to because I think they're risky.
Yeah, the ETFs do the job. They've been doing a great job anyway. So
what's that, sorry?
The ETFs have done a great job anyway, so
yeah.
They haven't really needed to go into that level of risk.
Yeah, but it's just this weird thing about people wanting to buy companies.
Yeah.
Right? Because they just think that, they're going to hit a Tesla or they're going to hit a Bitcoin or something. Whereas what I'm saying is, listen, your chances of doing that are, really, really slim. But if you want to give it a shot, fine. But, who's going to put 50 grand into a tiny mining stock unless you've got 50 grand that you just want to, blow out and go, yeah, right, I took a shot on it.
You'd be surprised.
Yeah, well, yeah, true.
But
I mean, who would have put 50 grand into Bitcoin in 2009? No one. Like, what people did.
Very few.
Very few. Yeah, you wouldn't do it.
But that's my point.
Yeah.
A lot of that stuff, and like you said, you've been riding a Bitcoin bull market, right? And why? Because there's cheap interest rates. Bitcoin's full of mainly young guys like yourself. There's
Get rich quick.
But get rich quick. Libertarians, the government's evil. We're going to control the money. All that sort of stuff is exactly what happens in every stock market bubble, right? There's a new era. It's all going to change, and then shit happens. It all crashes, and we go, oh, well, it's just another cycle, right? Back to the grind. And, that's why I say the benefit of being old is I've been through a few cycles, so I've seen how it's gone.
Yeah. All right, well, let's wrap it up. I think people are probably a little bit bored of hearing about what we got to say. What are we in an hour? Yeah, 57 minutes. Look, from my end, I just wanted to wish everyone a Merry Christmas, and if you have any questions or comments, please head to the socials and the website totalmoneymanagement.com. And particularly, I know we've mentioned the wealth strategies, but genuinely, if you have any questions and want to know more, just send us an email.
Get in touch.
Yeah. Well, other than that, Merry Christmas.
Merry
Cheers,
Christmas,
fellas.
gents.
Thank you.
Thanks.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.